Hey traders, Abel Delgado, Market Insights commentator here at Global Prime Forex. I believe that if you are a momentum or scalping type trader, this video may provide yet again another aha moment in your trading. So brace yourself because this is going to be yet again another golden nugget. As I've mentioned in several occasions, trading is really like any other business. That means that you must be prepared to incur costs of transactions in whatever asset you're interested in. In the case of the Forex market, you're going to be speculating by buying or selling a specific number of currencies or one individual currency. So, as I said in Forex, the stop loss placement would be the point in time that if hit would be just simply a cost of transacting business. However, that being said, it's also important that we look beyond this point and we understand we are in a position to really come to terms about what markets are going to be the most cost effective to be traded as it relates to the ratio or to the equation of volatility versus spread. So let me explain what I mean. So essentially, the lower the time frame that you're going to be trading, the more significance and the greater role that your spread is going to play. The reason being is because your stop tends to be tighter, which means that the spread is going to represent a larger chunk of your total cost of conducting business. So let me give you an example. Let's look at two different markets. The first one is the dollar against the JPY, and the second one that I'm going to be comparing it with is the Australian against the US dollar. By the end of it is going to be strikingly different, the approach that you have to take when understanding which one is going to be the most cost effective. So first of all, you will notice that the dollar against the JPY, typically at Global Prime we have a spread of about 0.5 pips, but the volatility on the downside is only 50 pips. So let's first concentrate on the first aspect here, which is the spread. So if you were to put on a position that has a 10 pip stop loss size, that position, once it's entered, once it's filled, that alone represents about 2.5% of the total cost of conducting this transaction. Whereas if you are putting on the same long position in the Australian against the US dollar, notice this tight thin red box. This is going to be the cost of conducting business in the Australian US dollar. Notice that the lower the spread, obviously the lesser the chunk that will represent from the total cost of the total risk that you're going to be incurring. So bottom line, only by cross-checking the spread of one pair against the other, it is blatantly clear, it is very obvious that the Australian US dollar seems to be a much more cost-effective market. But that as a standalone indicator is not enough. Then we need to understand about the volatility, and it gets even more compelling. Why is it that the Australian US dollar is a market that it's going to be more efficient, more effective when it comes to trading this this momentum type of scalping type of strategies? The reason being is because the total volatility per day in the dollar JPY is going to be on average about 50 pips, whereas the Aussie against the US dollar is going to be about 70 pips. What that means is that before the dollar JPY faces a ceiling for that day, just because the average move is just 50 pips, there's going to be little room to maneuver. Whereas the Aussie US dollar, since it has on average about 20 pips of extra room to be moving either up or down, there's going to be not only that cost-effective component, but also you're going to have a market that will be presenting more opportunities for it to move either up or down. Okay, so hopefully this is a clear example as to which market out of the two represents a more attractive ratio when conducting or when accounting for volatility versus the spread. So after running these examples, let's go back to the document that I was showing you at the beginning of my presentation. Now, you really want to have a head start whenever you put on a trade, and that means that it is paramount that you're going to be understanding the ratio of volatility versus spread. The reason being is because the higher that ratio of volatility per day versus the spread is, the less attractive is going to be traded. Let me give you an example. For example, on a 4-week basis, you have here the 4-week volatility average on all these pairs right here. The one that at this point in time continues and will continue to be, it's almost always been the case, the most cost effective is going to be the euro against the US dollar. The reason being is because now we seem to have fairly decent levels of volatility, only if only compared where we were, just say, pre-COVID era, where the suppression of volatility in this market took us all the way down to 35 or 45 pips per day. Now we are standing at 75 pips in volatility, and we have a spread to be paid which tends to be between 0 to 0.2. okay, so it ranges, it varies depending on the liquidity. So that puts us in a position where we get a 0.27% ratio. That means that this is a market that is fairly attractive to be traded, because the cost of conducting business, when also accounting for the volatility, makes it a very low ratio. Okay, so this calculation is going to be comprised of the pips that this currency moves per day divided by the spread that you typically pay on this market in global prime. Now looking at the next one, Aussie against the US dollar, it offers very similar levels of volatility, yet the spread here, you know, I did write 0.4, but typically is way lower, just because I think I did type these values yesterday, and yesterday was a public holiday, so obviously that was a little bit inflated. So let's just say that this is 0.1, so it makes it even better, 0.13%. Now on the other side of the spectrum, we have the Aussie against the Canadian. Why is that? Because this is a market that tends to move just about 60 pips on average per day, yet you have to pay a spread of 1 pip. So if you're going to be trading momentum or scalping type strategies, this is going to put you in a much worse position the moment that you open up the trade. The reason being, as I said, is because you're going to be incurring in a lot more cost, as you know, the chunk that the cost you're going to be paying right off the gates as part of your trading when compared to the total size of your stop is going to be much greater. And on top of that, not only the spread, but on top of that, if you could justify that the market is going to be moving 200 pips, perhaps it makes sense. That's why we have this ratio, okay? And that's also why we have, for example, here GBP JPY giving us a ratio that is kind of like borderline what I would be accepting, which is 1%. Reason is because even though the spread might actually be, you know, between 1 pips to 1.3 pips, it varies based on liquidity. But here the liquidity that gets to be displayed on a daily basis is 130 pips. Therefore, this puts us in a ratio of 1%, which I would say this is still acceptable. Okay. Now looking at the dollar JPY, just a paltry 57 pips on average. And this spread, I would say, is fairly high based or compared to the other standards, the best standards in the industry when, cross-checking Aussie US dollar, Euro US dollar, or even the pound US dollar, which even if it's at around the same spread, it gives us much, much greater volatility. So here's what I tend to do. I will go to Madoff.net. They have a volatility section, and at the end of every trading week, usually either on Saturday or Sunday, so whenever I can actually find a little bit of time to crunch these numbers, it really just takes me 5 minutes. What you want to do is you want to be monitoring both the average volatility on the 4-week and also on the 1 week. And from there, so here we have the 4-week average volatility. From there, you just want to be essentially just doing your own individual searches, queries, and coming up with the volatility. So Euro US dollar on a 4-week basis is 73, and so that came down a little bit from the 75 of the weekend. Okay, and then you start just filling up this different rows as it relates to every single currency, and then you just essentially note what's the typical spread that you're going to be paying. And the formula, as you can see here, tends to be, it's always, I should say, it's always C divided by D. So essentially you're going to be dividing the volatility against the spread, and that gives you that ultimate ratio that you want to be paying attention, and from there selecting what markets are going to be most attractive to be trading intraday in your 1 minute, in your 5 minute, etc. Now, if we go back to the 1 week average to range, since there was massive suppression of volatility in the forex market last week, there's only 5 markets that justify to be traded on an intraday basis, if only accounting for the actual volatility of last week. So what I tend to look for is congruence between the 4 week and the 1 week. And even if we don't have this this agreement in with both tables, I'm gonna also be looking to understand what drivers do we have in the week ahead. Do we have central banks? Do we have non-payrolls? Do we actually have geopolitical headlines that are starting to actually get a bit more of airtime? If I had to really select only one single table that I would be sticking with, to me that's the 4 week ATR. The reason being is because you allow a little bit of you allow yourself a little bit of flexibility, not to just simply be determining the markets that you select based on 1 week worth of data, but rather if that's spread across 4 weeks, that definitely creates a bit more of a accurate picture on where we've stand or where we've stood as per the last month. Okay, but if you have that congruence, the more the better. All right, so the bottom line is that this is a very, very useful exercise to be conducting if you're going to be trading the 1 minute, the 5 minute, or the 15 minute perhaps, depending on the stop loss size. The higher you go onto your time frames, into the daily, into the 4 hour, the less relevant this information is going to be, because remember that it is all about the size of your stop loss and how that relates to both the volatility that you're going to be expecting on a daily basis and also the spread that you're going to be paying on that pair. You always want to be stacking the highest odds in your favor the moment you open up a position in the lower time frames. That's critically important, and that's why this document is going to also, if you're interested, be made available to you. So reach out to me through our Discord. The link is down below. If you want to actually engage in further conversations, in follow-through questions, you have the comment section down in YouTube, or you can visit the Discord room and I'll be more than happy to attend your questions. It is all for me. Hopefully you've enjoyed and you've had yet again another potential aha moment as part of your trading. And that's all I wanted to share for today. I beg you all, and I'll be back with more videos tomorrow. Cheers.